We just finished the best week for the stock market of 2024, and we've enjoyed just an upward market for 5+ months. And if you look at the last 16 months, it's just been a superb stock market. It really reminds us that you got to stay invested in the stock market. Sometimes prices seem to be really high. You just got to keep holding your stocks. Even if a stock looks to be overpriced, if it's a company that you believe in, got to hold on to it. That's a lesson that I'm taking out of this market. I didn't sell any of my stocks, even though I believe that Meta, as an example, is a little overpriced. I didn't sell one share of Meta. I kept buying into Google, which is a company that I think is undervalued. I'm holding on to my Uber stock. Every single share, I'm actually buying more Uber, even though I believe the price is a little high. And Netflix, I think is a little high, but I just keep these stocks because I think the companies are great. I'm a long-term investor, and I'm aiming to make a lot of money over a long period of time. I'm not a day trader where I'm looking for a quick buck. No, I'm looking to grow my portfolio, achieve a great return year after year. This year, the first 3 months look great. And in this video, I'm going to look at the statistics. I'm also going to look at the AI hype and compare it to other periods of time when we had a similar frenzy. I'm also going to share with you the stocks that I'm buying and selling. And last, I'll conclude with what I think the rest of March looks like and what my plan is going into April. The S&P's performance in 2024 and in 2023 has been great. If you look at just in 2024, the S&P's up 10%. But if you look at just from the late October timeframe up until this point, which is about 5 months, it's up 27%. So that's just a great run by the S&P. If you look at from the time we had the low in 2022, which is roughly about 16 months ago, we are at a 46% return on the S&P. That's just been a great run for stocks. And again, a reminder that I have to stay in stocks because you never know when this market's just going to keep going up and up, and investors are going to come in to drive up prices on stocks. Comparing the S&P to the other indexes, which is the Dow Jones, the Nasdaq, and then the Russell 2000, which is made up of the smaller companies, small and mid-cap stocks. The S&P is doing well, but not keeping up with the Nasdaq. The Nasdaq over the past year is up 40%, and the S&P is up about 32%. The Dow is up about 23%, and then the Russell is up 20.4%. The sectors that are performing the best so far in 2024 are communication services, which includes Meta, Google, Netflix, information technology, which is where Nvidia, Microsoft are. Energy is doing really well. And the reason for it is oil prices keep going up. Financials are doing quite well, and industrials are really doing well. Industrials, I think, are a sign that the economy is in pretty good shape. I think it's going to start growing, and it'll grow in 2025, 2026. The S&P as a whole year to date is up 9.74%. The sectors that are lagging the S&P year to date include materials, and I think materials have a lot of upside, but right now it's lagging. Healthcare, again, I believe healthcare has good upside, but it's lagging the S&P. Consumer staples, which is understandable. Consumer staples should never be a high performing sector. Consumer discretionary really pulled back. They were doing really well at the end of 2023, but now consumer discretionary as a whole isn't doing all that great. Utilities is down, and then real estate's way down. Higher interest rates, higher for longer, means that real estate companies are really going to struggle to make their properties work. Basically, they have to take on so much debt to be a real estate company. That debt costs more money. It costs more money to do projects, to own buildings, and so forth. Looking at the performance just over the past month, information technology is number one. It's up 8.21% just in 1 month. And you can thank Nvidia as well as other companies that are really participating in the AI hype for that big gain. Energy is doing great. Oil prices move up. Oil companies make a lot of money. Materials is really showing up. Industrials really showing up. And then communication services is right there. The S&P is up 5.07% in 1 month. The sectors that are not keeping up with this S&P right now are financials. I think they have great upside this year. Financials do. And banks really had a rally this week. Utilities not keeping up. Consumer discretionary, staples, real estate, and then healthcare over the last month has really been lagging, which is somewhat of a surprise, but I think there's opportunity in healthcare. With stock prices going up, there is a concern. Are stock prices too high, overpriced? So I wanted to take a look at PE ratios and see where they are and historically. Now, most recently, PEs were measured to be just slightly above 20 PE, which is a pretty high amount. Now, it wasn't the highest that it's ever been. In fact, recently, 3 years ago, it was higher. Now, what's important to point out is in 2022, we had a down market. So once we had that down market, we saw PEs really come down because prices of stocks went down. So are we at a point where it's really alarming? Not yet, but it's getting there. I think if we continue to see prices go up, the PE ratio is going to go up, and then we should see a correction. Now, when a correction would come, nobody can say. It might happen next week, next month, it may happen in 5 months. We don't know. Taking a closer look at PEs and seeing which sectors are overpriced or underpriced based on a PE ratio, and comparing the current PE ratios by sector compared to their historic PE ratios. Looking at information technology, the current PE is higher substantially compared to its 25-year average. Discretionary, consumer discretionary is similar. The S&P as a whole, the PE is higher than the 25 historic norm. Industrials, consumer staples, materials are all, the PEs are much higher than the historic measure. Healthcare is maybe a little more reasonable, but still the PEs are higher than the historic norm, along with telecom services. Financials is also, the PEs are measuring at 15, but historically they're around 13. Once we get into energy, that's the one sector that potentially has some value there because historically they had a PE closer to 15, but they currently have a PE around 12. So that might be an opportunity to catch some value in energy. AI is the hottest topic on Wall Street. It seems that AI is really being mentioned quite a bit by a good number of the Fortune 500 companies. It's really being repeated. Companies, especially tech companies, are really positioning themselves as AI companies. So the amount of references to AI are really high. Now, is it more hype than fact? I don't know. I think that AI has an interesting future. I do think it's being overhyped right now because it may take a long time to get to an AI useful business model. It may take a long time for ecosystems to be determined. Who are going to be the winning companies? Which companies are going to be the losers? Which new companies are going to come out and really take this AI business on? So there's just a lot of open questions. Now, which companies are talking about AI the most? No big surprise. Nvidia is really talking about AI, and for good reason. They're one of the key companies that's helping build out all the infrastructure to make AI a reality. Salesforce is really talking about AI. Cadence Design, Alphabet, which is Google, really talking about AI. Microsoft, no big surprise. They've been really communicating AI. Meta. So Meta has Llama. They're communicating that. Hewlett Packard Enterprise, really talking up AI. Broadcom, they're talking AI, and then Arista Networks. So these are the companies that have just really have put it into their repertoire of talking about AI, and there's good reason behind it. They want to really pump up their stock. The talk around AI is not going to go down. It's going to go up. And the reason for it is the companies that talk about AI the most, they're seeing their stock price go up. So these companies are just going to keep putting AI into their communication so they can see their stock prices go up. At the end of the day, it's management's responsibility to maximize shareholder value. And if they could do it by just talking about AI, boy, that's a quick way of getting really nice market cap appreciation for the company. One of the companies that's really benefiting from the AI boom is Nvidia. They have the best technology for the AI build out, and there's huge demand for their product. That sent the stock just soaring from under $200 a share up towards $1,000 a share. Just an incredible parabolic move. This reminds me of another company that was in a similar situation around the year 2000 or leading up to the year 2000. We were building out the internet and there was huge demand for Cisco technology. They had the best internet technology, the best routers. All these companies had to buy Cisco, governments, you name it. The demand was huge and the market really pumped up the Cisco stock to the point where it went parabolic and then it collapsed. Why did it collapse? The market overplayed the amount of revenue growth, profit, free cash flow. And when it realized that, geez, priced at this peak would be much higher revenue growth and free cash flow, the stock collapsed. And a stockholder that bought near the peak has not recovered their investment in Cisco, even though it's 24 years later. Is the same thing going to happen to Nvidia? I don't know. But these charts look very similar. The other the other similarity is that the stories are similar. Huge demand, real demand for their products, highly profitable. Just the market is overplaying the stock price on Nvidia. My guess is Nvidia is going to be priced lower. Is it going to take 6 months, a couple of years? I don't know, but it's really beginning to resemble the Cisco situation, and that situation may repeat itself for Nvidia. I'm really looking forward to seeing what AI brings to the world and the benefits that it could really bring to the marketplace. It's going to be really interesting. But for now, I'm a value investor and I need to see real businesses. I need to really see evidence that that business is going to make money, it's going to produce free cash flow, and it's going to reward me as an investor over time. I'm not seeing that in a lot of businesses out there. For sure, Nvidia is benefiting right now, but there are other businesses that are tagging along that I don't know that I could say the same thing about those businesses. I don't know that they have real AI businesses at this time. They're just really talking about AI a lot, which may be the reason why their stocks are being pumped up. No matter what market we're in, there's always an opportunity to find companies that are undervalued. And over the last 30 days, here are the stocks that I bought and invested in. The biggest investment I've made is in Zoom. That was the biggest cash inflow into Zoom for my portfolio. I also bought some bonds that were issued out by Target with a 5-year maturity, and they yield about 6%. Alphabet is the second biggest stock that I've invested, and I think that their AI business is real. And the announcement at the Apple partnership potentially with Alphabet was big news. A lot of things I think factually really support that Alphabet may end up being the leader in AI overall. Apple's been sold off this year and it began to hit a discount level that I wanted to invest in. So I've put about $4,600 into Apple. Adobe, I think that Adobe with that big sell-off was a big opportunity. So I invested in Adobe. I continue to put money into Pfizer because I believe it's underappreciated and pays over a 6% dividend. Cigna, again, this stock is really good market appreciation and it pays a nice dividend. And for the rest of the stocks, I'll just let you glance at the stocks that I bought. But there's always a good time to invest in the right companies that are unappreciated and discounted. The one stock that I sold was BHP. This is a materials company down in Australia, and it's a really good company. They pay a high dividend. They mine for iron ore, copper, other metals as well. I decided to put all my investment. I owned both BHP and TX for Ternium. I decided to just buy into Ternium at a higher level and liquidate my BHP position with a good gain. As we move forward, I'm going to continue to buy into companies that are discounted. What I think is going to happen is at some point, we're going to have a pullback. I just don't know if it's going to happen next week, next month, in 3 months. Who knows? The one thing that I know for sure is I'm really glad that I stayed invested during the whole 2024 period, that I continue to buy shares. The stock market did surprise me by continuing to go up and just having a lot of enthusiasm, very little volatility. It just stocks have gone up. And I don't want to miss out on events like that. So it's better just to continue to put my money into the stock market and watch my investment go up over time. If we have a strong pullback, I'll be buying at higher dollar amounts so I can capture some of the discounts that a pullback will bring as an opportunity on companies that I really want to own. I really appreciate you watching my video, and I hope you found it interesting.